welcome to Macros with Mythili, our weekly show where we take a hard look at all the major macroeconomic issues and developments in India and overseas. Well, from the perspective of the financial sector, nothing could get bigger than this. The Finance Ministry has just put out a revised draft of the Indian Financial Code that aims to replace virtually all the laws governing the financial sector. But following the storm of protests over many of its provisions, especially those relating to monetary policy, both the Finance Minister and the Minister of State for Finance have been quick to distance themselves from the code, saying it's only a recommendation of the Financial Services Legislative Reforms Commission, the FSLRC. But the FSLRC report itself is virtually a minority report. Of the original 10 members, excluding one member secretary, 3 did not sign the report, and of the 7 who did, 4 members filed notes of dissent. So on what basis is the ministry not only persisting, but worse, tweaking its recommendations? We're going to discuss this and more with our panel of experts. Usha Thorat, former Deputy Governor, Reserve Bank of India, Ajit Ranade, Chief Economist, AV Birla Group, and Govinda, member of the 14th Finance Commission and also of the FSLRC. Welcome to the show. Govind, before we started, you were telling me that these revisions are really the work of the Finance Ministry and not of the FSLRC. In fact, some of the other members also of the Commission said the same thing to me. So what, to your mind, is the basis for these revisions?
If you look at the FSLRC recommendations, it doesn't take away the veto power from the Governor of Reserve Bank. Basically, what it says that we need a wider consultation, and that's major. That's the most important issue. In fact, it asks for, apart from the 2 members from the Reserve Bank, it asks for 3 members to be appointed by the government and then 2 members to be appointed by the government with the approval of the Governor of Reserve Bank. And it also talks about, the possibility or if necessary, the governor can, the chairman of this thing can take a veto, but he has to explain to the why he has done that sort of a thing. So it doesn't take away the powers, and I don't think that is the intention of the FSLRC. But let me also make a point that you see, if indeed the Reserve Bank has the responsibility of maintaining price stability, you cannot really take away the powers of the Reserve Bank governor from exercising authority on what he has to do.
Absolutely. In fact, Usha, that brings me to the crux of the argument. It is true that both the Finance Minister and the Minister of State for Finance have rushed to clarify that the RBI's primacy in monetary policy formulation will be retained. But the ministry's actions seem to be at variance with this. We just heard Govind say that how can you expect the RBI to maintain price stability if you take away the governor's powers to decide what is right? Moreover, these draft code recommendations seem to be at variance with the Monetary Policy Framework Agreement, which clearly said, and I quote, that the governor, or in his absence, the deputy governor will be responsible for the policy rate in order to achieve the inflation target. So what is really at the bottom of this financial code revision?
Actually, I don't think we really need to worry about what is at the bottom of this financial code revision. I'm very grateful that this has happened because it gives an opportunity for everyone to actually sit up and look at these proposals and actually give their inputs and help a much wider debate. In fact, I would just trust the Finance Minister and the Minister of State for Finance when they say that this is merely an input and that they would be taking into account the wider feedback that they get before they go forward with any legislative proposals. So I think that's a very positive thing, and I'm quite grateful actually that whatever has happened because it actually provokes a debate. Now, let's look at the substantive issues. If we look at the monetary policy agreement between the Reserve Bank of India and the government, which has already been signed, it says the objective of monetary policy is to achieve price stability while striking a balance, primarily to maintain price stability while keeping in mind the objective of growth. The new code says objective of monetary policy is to achieve price stability while striking a balance with the objective of the central government to achieve growth. Now, this itself is something very different from what has already been agreed. So I would say that I think there is a lot of way to go before there is a final agreement on what should be the objectives of monetary policy. And I would really say that since it has already been accepted by the government and Reserve Bank as late as February 20th, 2015, we should really go by that. The second point is about the composition of the Monetary Policy Committee. There too, I think nowhere in the world do you have a monetary policy decision-making committee which has got a majority of external members. So I think it goes without saying, and I think it's important, and this is what was even envisaged, that you need to have a monetary policy committee which consists of a number of experts with experience, but clearly either through a veto, or if not a veto, through a majority of members representing the central bank, there is, the decisions are taken. The kind of transparency that is needed for ensuring that the public at large understand the nuances of what made certain decisions or who voted how is all available. So I don't think that there is really a very too much of an issue. In fact, the whole idea of having a separate monetary policy committee and the idea of having a central bank itself is to ensure that price stability is looked after by an authority which has got a long-term stake in the entire country, as against a sovereign which may be there for a shorter period of time.
Ajit, would you agree with Usha that the very idea of having an independent central bank, if not in law, at least in practice, is to ensure that the long-term benefit of the country is kept in mind and it's divorced from short-term political interests, and the IFC defeats that purpose?
Yeah, absolutely. I mean, like Usha said, in fact, the world over, the best practice is to have a committee which is responsible for monetary policy, but whose membership is much longer tenure than the shorter electoral or political cycles. So if you don't have that, then if you have members who are appointed for 3-year terms and who are political appointees, then it's possible that they might be tempted, they might be biased towards taking decisions because of electoral or other compulsions. So to divorce that, it's not, there are two different domains, the fiscal domain and monetary domain. And as Usha said, the primary responsibility of RBI is the central bank is price stability, or as Governor Rajan in his maiden speech said, my job is to protect the value of your money. So if that is the primary purpose, then you need to insulate it from these kind of electoral cycles. And that is why indeed nowhere in the world, at least in the developed countries, do we have short-term or political appointees. And by the way, in this draft code, they have proposed this 7-member committee with 4 members appointed by the government, and they say they'll be appointed on the basis of Schedule 1. And if you go to Schedule 1, I don't think it specifies any expertise. Presumably, even if the government, even if you go by this draft code, you need to have people who understand money, the financial sector, monetary policy, who are experts in economics or technical subjects. Nowhere in the schedule actually specifies that. So if imagine, the worst case scenario is that you have appointees who have zero background and purely out of political consideration. That's of course the worst case, but I'm just saying. So therefore, I think the current setup is really the one which is in line with the best practices world over, and it has worked. Let us also not ignore the evidence. If there is one singular achievement in independent India, is that compared to all the developing countries which experience hyperinflation, at least on one record, more or less our inflation management record has been pretty good. In fact, spectacular, that we've never had episodes of hyperinflation. That means there is something that has been done right. So if it ain't broken, don't try to fix it so hastily.
Exactly. In fact, that's what the governor himself had said earlier while talking about the FSLRC recommendations. But since all our experts are agreed that the IFC code seems to have erred grossly on monetary policy formulation, we'll take up the other issues later, but after a break. But please do stay with us. Welcome back. You're watching Macros with Mythili, and we're discussing the latest draft of the Indian Financial Code, the various flaws and the various right things about the code with a panel of experts, Usha Thorat, Ajit Ranade and Govinda. Usha, if I may start with you this time, you've been a regulator for very long. The code also seems to suggest a slightly, bifurcated way of financial sector regulation, with the RBI basically having regulatory oversight, as it were, only over banks and leaving out a large part of the non-banking financial system. Given the systemic risks, given the fact that the global financial crisis has shown us that you need one regulator looking at financial stability, has the code again erred on this?
Mythili, I'd like to make a difference between prudential regulation and systemic risk regulation. So if you just take the prudential risk regulation, there have been many experiments in the world. There has been a single regulator responsible for all prudential regulation, which is what the UK example was before the crisis. Then you have several regulators where you have separate regulator for insurance, securities markets, and for banking, multiple regulators. Or you've had examples, which is really the example of the US. Then you've also had examples of twin peak regulators, which are really one regulator for prudential, one regulator for consumer protection, and then there is an overarching financial stability council kind of. So I think each country has to adopt what is really best for it. And I'm glad that in the revised code, the banking regulation is, clearly vested with the Reserve Bank of India, because as the crisis taught us that irrespective of what the role of the central bank is, banking is something, the banking regulation is something that really definitely for systemically important banks has to be with the central bank. And this is what has happened in UK, for example. So I think we cannot ignore what's been happening all over the world and just adopt a unified financial regulator. While there could be issues, while if banking regulation is with the Reserve Bank and other segments regulation is with the financial agency, what would be the mechanisms for coordination? But these certainly can be overcome. So there are two specific points which I'd like to make here. One is about NBFC regulation. See, NBFC regulation, or say regulation over the NHB, I mean even NABARD and all the financial institutions, it's proposed that will be given to the financial agency because they're not banks. Now what you're really doing is, these are all credit institutions, and what you're doing by the proposal is to segment the regulation for credit institutions, which can then get fragmented, and there can be regulatory arbitrage. Our experience with NBFCs shows that there has been a good bit of regulatory arbitrage. Plus, these are also in agencies or institutions which do a certain amount of financial leveraging. And any institution which does credit and does financial leveraging is more akin to a bank, and therefore logically should come with the banking regulator. The second aspect of it is, most banking groups are actually conglomerates, at least the large ones. So they have within their domain, within their group, organizations which are doing insurance, which are doing other things. Now, while those insurance companies or asset management companies could be regulated by the concerned regulator, the banking group as a whole is what is the unit for regulation under the entire Basel umbrella. So the regulation and oversight on financial conglomerates, in which the bank is one of the major aspects of the conglomerate, is something that has to be with the central bank, with the Reserve Bank and with the central bank, and therefore I think it is necessary that these nuances are also brought in.
Ajit, but would you agree with Usha that financial stability is much too important to be left to a fractured system of regulation, and the central bank is the best authority to look after financial stability?
India's case is that it's bank dominated. In fact, a large part of Europe also continues to be. So the bank financing, or banks are the most dominant sort of presence in our financial sector, and especially in funding. If they have centrality, then their regulation and with the central bank, then all other elements, like Usha said, non-bank finance companies, I think naturally come in the same ambit. Incidentally, the UK, which is the most recent example that we can look at, they have gone back. They had the financial FSA, but now they realize that it is better to go back to the older model. So I think the fact that India will continue to be bank dominated because of our special unique situation of SLR and so on, and lack of that our financial sector is not deep enough yet, the sort of relatively less developed securities market or corporate bond market. In such a situation, I think it makes sense to give centrality to the dominance of central bank as the regulator.
Govind, do you think the RBI should have centrality in financial sector regulation, or does the RBI already have too much on its plate? And is there a case for shifting some of its responsibilities elsewhere?
I disagree with Ajit when he says that everything should rest with the Reserve Bank of India. I think Reserve Bank of India has too many things in its hands, and in fact, there have been lots, and in fact, the reason why the UK went back on the previous model is not because the unified system has been a failure. You take the example of Australia. In fact, there was a committee which recommended that the thing should be, the prudential regulation should be taken out of the Reserve Bank of Australia. And then, in fact, Reserve Bank of Australia, sort of agreed with that sort of a principle. And then, in fact, they have Australian Prudential Regulatory Authority, which has continued to function in an extremely efficient manner. But then there is a tremendous amount of coordination that has taken place between the Prudential Regulatory Authority as well as the Reserve Bank of India, and they have very constant meetings. Now, the question that one has, the problem that one has is that you have too many regulators. You have regulation for insurance, superannuation funds. You have regulators for, obviously there is SEBI, but so there is a lot of compliance cost, and with the new products coming into the market, there are lots of compliance costs. Not only that, there is a lot of regulatory arbitrage. Now the point is, so the FSLRC, after looking at all the experiences, made a recommendation that the banking regulation will continue to vest with the Reserve Bank of India for the present. Of course, that's not been taken out. But all other regulators, they can specialize in regulation in various sectors, and then therefore, in fact, they wanted a unified regulator. I don't really see any risks with that sort of a thing. Of course, there is a question of coordination, and obviously the coordination has to be done. But my own listing is that banking regulation should surely rest with the Reserve Bank. Now the point is that we have seen a situation where there are no regulations at all. And,
that is true. That is true.
Case and thing.
That is true. So on the issue of regulation, I think Usha and Ajit have one view. Govinda has a slightly different view. But I'm afraid it's time for us to slip into another very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the revised Financial Sector Code draft. Usha, the Financial Sector Draft Code also talks about capital controls and the role of exchange control management. Given that all financial products have been given to the control or the regulation or the unified authority, how does this affect the RBI's ability to control and regulate things like forex derivatives?
Yes, Mythili, I think there are two aspects to this, frankly. One is just on the capital controls. That is, how do you deal with non-residents? How do you deal with inflows? How do you deal with outflows? And how do you, have kind of limits on debt, on equity, and so on. The other aspect is about the foreign exchange markets itself. Now, by virtue of being a monetary authority, the RBI can, target price stability either through the exchange rate or through interest rate or even both. And exchange rate management, to my mind, is clearly within the purview of the Reserve Bank of India, although even the present RBI Act does talk about the central government really being, ultimately responsible for the exchange rate. Anyway, the way it's actually operated, it's been really something on which there is an enormous amount of close coordination between the Government of India and the Reserve Bank. Now, the day-to-day, obviously, management of the exchange rate is something that is left to the Reserve Bank. Now, when you look at foreign exchange markets, because the RBI has been given the jurisdiction, even the new code on regulation of the authorized dealing system, that means any trader, any dealer in foreign exchange comes squarely under the RBI purview. So effectively what you're saying is you have got regulatory authority over the foreign exchange market. And if you have regulatory authority over the foreign exchange market, it sort of logically follows that you have authority over the derivatives based on the foreign exchange markets. So I think on that I'm really not so much concerned. What I am actually more concerned is that in the chapter on capital controls, it's all not very clear at all. And maybe deliberately it's been left in a manner that it can be done through subordinate legislation or bylaws and things like that. What it really says is that government will decide on capital controls, and in doing so it must consult the Reserve Bank. Nowhere does it say that the government and the RBI would control, or that RBI will have a say where it affects financial stability. So I think something to that effect has to be brought in those principles, because the principles which are articulated there are really more talk about national security, and it doesn't really give any role to the RBI to bring in, to suggest or bring in or have the authority to have equal say as government in the matter of certain areas of capital flows which we are particularly always concerned about, which is really the debt flows. So I would think that the code really requires a little bit looking at from this angle, so that it is clear that the RBI has an equal say in some of the aspects, especially on the debt flows.
Ajit, would you agree with Usha again over there that RBI needs to have a greater say and it should be more clearly enunciated? Because so far the RBI has done a fairly decent job of exchange rate management. We may quibble about the fact that the rupee is overvalued, but by and large we haven't seen those phases of instability that many emerging markets have seen.
Absolutely. Mythili, you see, the exchange rate is basically the external value of the money, of the rupee. And domestic inflation captures the internal value of the rupee. Now, you certainly can't have a wide disparity between the external value of the rupee and the internal value. So, to that extent, if the RBI is responsible for price stability, implicitly that also means having to control or have some management of foreign exchange rate, because that is an instrument of price stability. So, it makes sense to that as Usha also said, that all the authorized dealers actually come under the RBI. How can you not have an exchange rate management residing with the RBI? Having said that, what strategies they will follow? Will they primarily focus on interest rate as an instrument to achieve price stability, or a combination of both interest rate and the exchange rate? That will depend on the context of the day. Now, in the last 20 years, the world has been plagued by several financial crises, and the frequency is increasing, and more these are currency crises. So, the currency management has become very, very crucial, and especially in an increasingly open macroeconomic world. So, there I think you cannot divorce exchange rate management from domestic price stability management to the extent that they are linked. And as you said, the record also is pretty, we should not, by the way, when we talk about these theoretical things about changing the laws or reforming the financial code, we should not completely ignore the track record. If what has worked, we should learn from what has worked as well. Completely junking that, somewhere I read in the op-eds that this is an archaic 1934 RBI law, RBI Act. So if just mere passage of time makes something meaningless, maybe the Americans should junk their constitution. It's like 250 years old. So I think, I think basically our track record is equally important in considering what changes. As I said, we need to make changes, but let's not make them hastily. That's the main point.
Mythili, I just want to make if I may. See, I don't think the code is challenging the RBI scope on exchange rate management, because it's given the regulation of authorized dealers entirely to the RBI. Maybe a little more clarity on whether you are allowing, when forex derivatives are traded on the exchange, on the futures, in the futures market, in the stock exchanges, therefore what will be the kind of role RBI will have. But I think the more important thing is really on the fact that you just cannot manage capital flows only through the exchange rate mechanism. You also have to have some kind of quantity tools, which are really what capital controls are all about. So it's both in terms of the amount that you're controlling, the inflows and the outflows, as also the exchange rate. So this is a package of tools that are to manage currency, which is very critical to price stability, to financial stability. So I think that is where I said that I would not worry so much that exchange rate management has not been clearly given to RBI, because I think it is, but really more on the actual capital controls.
Okay, so let me give Govind the last word. Govind, where do you stand on this, on the matter of exchange rate management and capital controls, the RBI in the IFC code?
Exchange rate is a function of a number of variables, not merely the capital flows. You need to look at the imports and export, and for that reason you can't simply say that, no, in other words, everything depends upon everything else. So, you need to really be very careful about that. As far as the whole issue of capital controls is concerned, FSLRC, that was one of the most controversial issues in the FSLRC report. And the report said that capital inflows will be, as I said, the policies will be determined by the government in consultation. And then they have also detailed in one of the tables what sort of a consultation that is required to be made. And outflows will be determined by, the regulation will be done by the Reserve Bank of India in consultation with the government. And the question is how exactly you can work out, to put together this whole question of consultation, because the inflows also, there are a number of other issues involved, including the whole issue of investment, investment in the economy, the issue of security and various other reasons, and therefore, this sort of a thing was done. Now, of course, there is a difference of opinion, and there are differences of opinion, and then obviously the perceptions would be different. But the basic issue is this has to be done in coordination, in consultation, in sync between the government and the Reserve Bank of India. And, in fact, given the fact that there are multiple issues involved.
Well, yes, Govind, yes, there are differences of opinion, but as argumentative Indians, that is only to be expected. But what is very clear from the panel discussion is that there are many aspects of the IFC, of the code, which need to be rethought and reworked. And I do hope the government will take action on that. Thank you so much, Usha, Ajit, as well as Govind, for joining me in this panel. Thank you also for watching, but we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.